Well, hello, everybody. It's Don Garman here from Mirador Capital Partners. Happy June. Can't believe the first 5 months of the year are already in the books, but here we go into summer. I'm sure you'll share the impression I'm getting that the world is returning to normal. I've spent a little bit of time in airports over the last couple of weeks and in full planes, and obviously as the vaccine rolls out, I think we're all excited to get back at it, and where I would have expected that things like hugging and handshakes would have taken a while to return, apparently they're back. So that is in full evidence everywhere I look. And anyway, as a fully vaccinated guy, I can't be more thrilled to get back to whatever the new normal looks like. And so I'm going to keep it short and sweet today, but I'm going to go back to an old theme that I haven't talked about, or we haven't talked about in many months. But I'm going to answer the question that I have gotten, not so much in the last couple of weeks, but certainly a couple months ago, which is why wouldn't we, considering the serendipitous nature of the Jerome Powell stimulus-led saving of the markets and economy, shouldn't we be getting more cautious? So, while we had our little turbulence in, March, April, and some of May, I'm going to go back to a theme, and some of you will remember how many months seemingly in a row we talked about this, why we won't use now as the time when we're going to make the call that we need to get a lot more cautious. And so I'm going to try to share my screen, and I hope this will come through as I hope it will, which is the really looking at this line right here, the top line, which is our old friend, our earnings per share actual in blue and projected in whatever we're going to call that, red-ish. And so the answer to why we are not going to get more cautious today has to do with looking at December or calendar year 2019 earnings per share, how much money the S&P 500 in aggregate earned was $160.40 in 2019. Then we had a global pandemic. Revenue, as we all know, this time last year, a lot of things got shut down, but a lot of things didn't. And commerce, e-commerce was still holding in strong, and a lot of revenue went into other places than restaurants and movie theaters. But earnings did go down a lot to 137.97. But what we're working on now is the estimate for earnings this year of 187.56. So the rate of increase from 138, call it, to 188 or 187.5 is huge. And then another huge estimate increase of 209.70 in 2022 expected today, and 228.84. So my point in this little exercise is to say, while we are in this steep, accelerated earnings expectation mode, we're fine in the sense that it's hard to see the averages or stocks moving drastically lower. Where we will start to have concerns is when the rate of change starts to even decelerate its upward slope. So if something goes from projected to grow at 40 or 50% to grow at 30 or 40%, those are massive implications for prices. So that it will be the time, just so everybody is clear on the playbook, when things will start to shift from a positioning standpoint for us. But until then, we're sticking with our positions, which we are very happy with, and I hope everybody can agree that it's been a relatively unexpectedly good year so far, and we will knock wood and hope it continues through the summer. and into the fall, but fully expecting that by the time we're doing these videos in the fall, the tune will have changed, the winds will be swirling again, and we will be hopefully strapped down and ready to brace for some cooler weather in the fall, metaphorically speaking, in the markets. But so I'll leave it for that for now, and say thank you to all of you, and I hope you're enjoying some of these nice warm days, these early summer nice warm days, and everybody's getting outside and seeing friends and family. So thanks again. Let us know if you need anything, and until next time, that's it for us. Bye.